Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Exela's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Exela Technologies is a business process automation company. I'll give you some examples of what a business process automation company does. One thing they do is they automatically generate and distribute reports. Another common thing these companies do is automate HR tasks to set up user accounts. A popular thing these days is to automate your inbox to process info quickly and efficiently. The company can automatically navigate to websites and grab info and put it into Excel spreadsheets. They can batch customer invoices and process them with little to no human intervention. To put it simply, it uses technology to automate manual tasks within an organization. This helps companies minimize costs, increase efficiency, and streamline procedures. Many large companies have divisions dedicated to these efforts, but there are plenty of small and even large companies that can benefit from the assistance of a company like XELA. XELA was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. At the end of 2017, the merger was completed and XELA received $275 million in cash proceeds. The SPAC that acquired XELA was QUINPARIO Acquisition Corp. The company is headquartered in Irving, Texas and trades on the NASDAQ. Let's get started with the model. This is a micro-cap company, 205 million market cap. They're trading at 79 cents a share, and they have 259 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They are losing money each year, so they have negative free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative every year. Revenue is a sales for the company, and that declines from 1.6 billion to 1.2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor is a big expense for this company. Revenue minus cost of revenue gives you your gross profit, and that declines from 380 million to 280 million. Below that is their operating expenses. Marketing is a big operating expense for this company. Gross profit minus operating expenses give you your operating income. That has declined from 42 million to 18 million. But they did improve from 2020, negative 16 million to positive 18 million. And their revenue is lower in the trailing 12 months when compared to 2020. Below that is the interest they pay in their debt, and they do have a lot of debt, so they paid 172 million of interest payments. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example of this is an asset impairment. Below that is their pre-tax income, then their taxes. And the bottom line of the income statement is their net income, which is negative every year. Here's a breakdown of their revenue. 81% in North America, 18% in Europe. 27% of their revenue is in the banking and financial services sector. 23% healthcare, 18% commercial, 9% in insurance, 5% in tech, 11% in the public sector, and 5% in legal. Most of their revenue comes from automating tasks, 92%. This is the income statement from their latest quarterly report, the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. So their revenue is down from 305 million to 279 million. Of the 279 million, 228 million was from the US. They had 208 million of revenue from information and transaction processing solutions, 54 million from healthcare solutions, and 17 million from legal and loss prevention services. The expenses directly tied to generating the 279 million is 212 million. That gives them a gross margin of 24%. Gross margin is gross profit over revenue. That's a lot lower than their industry. The median is 59%, the average is 49%. Selling, general, and administrative expenses is 43 million, depreciation and amortization 19 million. Their operating profit declined from 5 million to 2.4 million. They're spending a little less interest on their debt. In the third quarter of 2020 it was 44 million, now it's 42 million. So they had a net loss of $13 million. Last year was a net loss of $28 million. In the first 9 months of 2021, a net loss of $72 million. In 2020 was $90 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or gains from its operational business. They did have positive operating cash flow in 2018, but negative after that. They do spend a little bit in CapEx, $13 million in the trailing 12 months. Operating cash flow minus CapEx give you your free cash flow, and that's negative every year. They're mainly running their business on debt. In the trailing 12 months, they did pay down more debt than they issued. But in 2018, 19, and 20, they issued more debt than they paid down. This is their operating cash flows from the company's 10Q. The first 9 months of 2020, the first 9 months of 2021. To calculate operating cash flow, we start with a net loss of $72 million. We have to add back depreciation of $58 million. And they pass through a gain of $28 million on the extinguishment of debt. So we have to minus that out here on the statement of cash flows. And then some other smaller items. We also have to adjust for changes in working capital. It looks like they added accounts payable in the past, and they're paying for it in this reporting period. They pay $57 million on accounts payable. So even though they reported a net loss of $72 million, they actually lost $74 million of cash flow. Last year, they lost $66 million of cash flow. This is the investing and financing sections from their statement of cash flows, the first 9 months of 2020, the first 9 months of 2021. The first thing in the investing cash flow is investments in PP&E. They spent $7 million this year and last. They invest a lot in their software. It was $1 million this year. Last year was $3 million. They acquired a company last year for $12.5 million. And last year they received $50 million from the sale of assets. In their investing section, they had a cash outflow of $3.6 million. Last year was a cash inflow of $28 million. In their financing section, they raised $25 million from selling common stock. This was a private sale. They raised $249 million from a secondary stock offering. They added $102 million of debt, but they also paid down $105 million. They had a $178 million cash inflow in their financing section. Last year was $67 million. This is the equity section on their 9/30 balance sheet. They raised $700 million from selling their business, and they lost $1.5 billion from running their business. So it doesn't look so great. They have a deficit of $730 million. Let's look at the capital structure. They have negative $733 million of equity, $1.5 billion of debt. So there's 0% equity, 100% debt. I gave them the highest whack on Finbox, 16%, and that's a discount rate we're going to apply to the future cash flows. We estimate 3 years of future free cash flows. We estimate a terminal value, which is all cash flows past year 3, that's $814 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $537 million. We divide that by 259 million shares. And we get a calculated stock price of $207. They're trading at 79 cents, so they're trading at a 62% discount. It's a buy according to the model. Their revenue is projected to increase 3.8%, so I grew their revenue 3.8% for the next few years. That's how I got their future revenue estimates. The average company in their industry converts 16% of their revenue to free cash flow. I cut that in half. I assumed they would convert 8% of their revenue into free cash flow in 2024. And I gave them negative free cash flow before that. Even though my model says they're undervalued, doesn't mean I think the stock is a good buy. I think it's more likely the company will go bankrupt. But if they do not go bankrupt and things go fairly well, the stock does seem undervalued. The website Simply Wall Street values the company at $7 a share. 2 analysts priced this stock, one at $3 and another at $5. This is where the stock has been trading the last 2 years. And this stock was being pumped up at different points. You can see on this day, the stock got well past $7, but it ended up closing below $4. So lots of volatility, lots of stock manipulation. They have a beta of 1.85, so the stock moves about 2 times the market. It's gone down 65% in the past 52 weeks, while the S&P is up 19%. The 52-week low is 35 cents, the high is 782, and the stock is trading below its 50-day and 200-day moving average. There's a ton of activity on this stock. Over 90 million shares have been traded on average each day the past 10 days. Of the 259 million shares outstanding, 176 million are on float. 18% are held by institutions and 4% are shorted. It looks like in 2017 when they went public, their employee count did go up, but it's been coming down a little bit. They currently employ 17,500 people. If you invested $10,000 into this company when it became a SPAC in 2015, your investment would be below $300 today. That's a 97% loss. You can see there's a good amount of insider selling. Every few months someone sells, but recently nearly 20 million shares have been bought by insiders, so that's a good sign. Here's a list of all the insider buying and selling, the date, the person or company, the shares, and the price. So everybody who bought in December is down a pretty good amount. 84% of the company is held by the general public, 11% by institutions, 2% by individual insiders, 1.6% by public companies, and 1.1% by private companies. The biggest shareholder is B. Riley at 4%, then HOV Services, Vanguard, Delos Capital Management, and HGM. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a really good price to sales of 0.2, so investors are paying 20 cents for $1 revenue. Their price to sales looks so good because their market cap has come down so much. Let's look at their non-current assets. They have $75 million of property, $60 million of operating leases, $360 million of goodwill. Goodwill is the premium you pay when you acquire another company. $256 million of other intangibles, $6 million of deferred income taxes, and $24 million of other. Deferred income taxes is an asset that's going to help the company pay less taxes in the future. They have a really low return on invested capital of 2.3%. They can only cover 10% of their interest payments with their operating income. That's not a good sign, because if you can't pay the interest on your debt, you're forced into bankruptcy. We can't look at the ROE since they have negative equity. They can cover 80% of their current liabilities with their current assets. Same thing with the quick ratio, it's 0.8. Let's look at their current assets. $146 million of cash, $25 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose, like to acquire another company or to buy a building. $188 million of accounts receivables. This is how much money other companies owe XELA. $16 million of inventory and $26 million of prepaid expenses. This is when a company prepays for a product or service that they're going to receive in the future. Let's look at their current liabilities. $60 million of accounts payable. This is how much money XELA owes other companies. $3.2 million of income taxes payable. This will result in XELA paying more income taxes in the future. $109 million of accrued liabilities. These are expenses the company has incurred but hasn't paid yet. $58 million of accrued compensation and benefits. This is owed to their employees. $23 million of accrued interest. They owe their customers $16 million. $17 million of deferred revenue. This is when a customer prepays for a product or service before it's delivered. They owe $48 million on a claim. $25 million are operating and finance leases, and $114 million of current debt. They look like they're in really bad shape. In the trailing 12 months, they had negative $51 million of free cash flow, and they have negative $72 million of working capital. So they're short $123 million. So it looks like they're going to need some debt or equity to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 233 companies in the same industry as XELA. These are the top 19 in terms of market cap, then XELA is below them. They spend less than average in CapEx, they have negative free cash flow, they rank 177th in terms of market cap at $205 million. Their price to sales ratio is much better than average. I noticed some companies have an amazing price to sales ratio right before they go bankrupt. Their revenue is higher than average at $1.2 billion, average is $900 million. Their 3-year annual growth rate is negative 9%, and they have a bad ROA and ROE. So to summarize, I have them trading at a 62% discount, but it's a really risky investment. You could make a lot of money doing a swing trade, but don't be left holding the bag. It looks like this company can go any day. I rank their free cash flows 1 out of 10, their revenue 4 out of 10, and the ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.